Hey everyone, it's Jeremy McDonald with Bayway Mortgage, not your average broker. And I'm here today with Kai Dumont from Top Shelf Credit. I'm also here with Daniella Ottone from the Ottone Group at Premier Coast Realty, one of Northeast Florida's top realtors. So today we wanted to discuss the importance of getting pre-qualified before you start shopping for a home. So Daniella, could you tell the folks at home why it's so important as a realtor that your buyers are pre-qualified before you start showing them homes?
Well, it's the first step when you're thinking of buying a house. The first thing you need to do is get pre-qualified. We need to know how much you're approved for, so we know how much of a house we can afford. And on top of that, it gives us, as a realtor, a guideline of how we're going to approach that negotiation for you as well. Because you're going to give them, and you're going to give me the tips. You're going to tell me, okay, well, maybe you want to ask a little bit more to the seller in concessions. So that's how we normally work. So it's very important that we know the amount before we go out looking for a house.
And for the good people at home, so concessions, what that is your realtor can actually request for the seller to concess part of their proceeds to go towards covering your closing costs. So if you have your down payment saved, but maybe not enough money for the closing cost, I would say probably 99 out of 100 of our contracts that we do end up having the seller actually cover the closing costs. So that's a very good point. Now, sometimes when someone comes to us and they try to get pre-qualified, their credit's a little bit short. So FHA mortgages are typically the most common. And with the FHA mortgage, we can go down to a 580 credit score, and you only have to put 3.5% down. But not all the time will that work. So Kai, what are some tips that you can tell the good folks at home about things that they can do to help increase their credit scores if they're not quite at that 580?
So for clients who aren't at 580 just yet, the first place I always like to start is payment history, because it's the largest category of your score. So the first thing they need to make sure that they're doing is making all their payments on time. Beyond that, they need to really make sure that they're maximizing their credit score. And so a lot of people are actually afraid to use credit, and they believe that by using credit, they're hurting themselves. But it's actually the opposite. You have to use credit in order to build your credit. So you have a lot of people that don't get credit cards, or they maybe won't take out a loan because they think that that's the best way to maintain a good credit score, but that's actually hurting you. So I would say really start building positive credit history and making sure that you're putting good things onto your credit profile. And another thing that I see that people really don't address until they get to the point of wanting to purchase a home is student loans. And that's definitely something you want to address ahead of time, especially if you're close to going into default.
Definitely. Default in student loans is definitely an issue, especially being a government debt. So can you kind of let the folks at home know, like with their credit cards, there's a difference between using a credit card and carrying a large balance. So it definitely is going to have a negative impact on their scores when they do carry that large balance. So in your expert advice, what is the ratios that you see? And when we say ratio, we mean how much money do you carry over on your monthly statement compared to the limit of that card? What are the ratios that you see are favorable?
So the best amount to carry over is going to be in between 1 and 10%. A lot of people think that having a $0 balance on a credit card is good, but it's actually not. So you want to keep your credit card balances between 1 and 10% of the limit. Below 30% is great, but ideal you want to keep that credit card between 1 and 10% of the limit. And that's really going to help you maximize the points in that category. The credit card utilization category of your score is worth a total of 165 points. So the more available credit you have, the more of those points you will receive in that category.
Awesome. That's fantastic. Thank you very much. So, if we run into a situation to where we have a client that maybe they're right under that 580 mark and they have a credit card and it's maxed out, it's a $500 credit card, and they pay that card down to under that 10%. So let's say $45. What have you seen the effect is on their credit score by doing something like that?
So that situation is going to depend, is that their only credit card? If that's the only credit
card. So let's say that it is, yeah. Let's say that it is.
And so it's $500, they max it out, and now you take it down to under 10%. So really, truly, that's going to free up a majority of the points in that category. You're not going to get all 165, but you're going to reduce your utilization, which is now going to give you And utilization is actually the category of your score where you can gain and lose points the quickest. So even if you have a high credit card balance 1 month, as soon as you pay that down, you'll get those points back the very next month. But it's hard to tell exactly how many points you're going to get because it does depend on different factors. But if you pay that card down a lot, you're going to see at least 20 points.
Okay.
So let me ask you then, that means that if that person with the 500 score, the 500 balance limit, if they use $100, the next month they don't have to pay the full 100, it will not be beneficial for them to bring it down to 0, they still have to carry some?
You want to keep it between 1 and 10%, not at 0. So you want to make sure you at least pay your minimum balance, but you do want to carry something over so that you can show that you are using this account. So keeping your credit cards at 0 actually penalizes you. So you want to carry something over into the next month.
Yeah, because I have seen that people that carries it at 0 for a very long time, they end up closing, and that loses like 100 points? Yeah.
Well, the thing is, the reason why they give you a credit card is because they want you to use it. The companies make money when you use your credit card because now they're making money on that interest when you pay the money back. So if they're constantly, if you have this money sitting out here every single month, like, hey, here's $5,000, hey, here's $5,000, and you never use it, they're going to take it and give it to somebody else because they're not making any money off of you.
That's interesting.
Yeah, that's very good to know. So another thing that I see a lot, on the mortgage side of things is clients that have recently paid off a collection account. And I always tell them, you don't really want to do that. It's not going to help your credit. So, Kai, can you kind of talk a little bit more about what happens to someone's credit when they actually go ahead and pay a collection account?
Okay. So in the beginning, when a collection account gets added to your credit report, it's affecting the payment history category of your score, which is the largest category of your score, is 35%. So when that collection hits, that's where you lose points, okay? When you pay that collection off, well, and let me say this too. So when it hits, you lose the points, right? As that account gets older, it doesn't affect as many points. When you pay it off, it updates the account. And so now it's on your credit report like a new account. So even though you've paid it off, it's still a negative account.
So it's a fresher strike against your credit.
Exactly.
Okay.
Even though you paid it, right? So you would think paying it helps. No, it's still a negative account. The only way to remove the negative effects of a negative account is to actually remove the account. And so I had a client before, had an 800 credit score, and paid a $52 collection, took him down to 670, paid it. I mean, and he couldn't believe it.
I think I know what client you're referring to.
I don't want to say any names.
Yes.
But yeah, he couldn't believe it. And so it's amazing how much a collection account can affect you. And you would think that paying a collection will help you, but unfortunately it does not. So the best way to reverse that is going to be to have it removed.
Stop calling you so you can dispute this and do it for the
Tell them
customer.
to call me.
Okay. And her information will be down below. So you definitely should reach out to her if that's the situation that you're in. So, as well, Daniella, when you have someone that has been fully pre-approved, and so I want to tell people there's a difference between being pre-qualified and being pre-approved. So we do pre-qualifications. We actually do those with a soft credit pool, so it doesn't affect your credit score. So a pre-qualification is, we know what your credit is, you tell us what your income is, and they tell us what their assets are, but nothing's been verified, nothing's been run through what's called an automated underwriting system. So a pre-qualification, we don't submit contracts with pre-qualified.
No.
Unfortunately, there are a lot of lenders and realtors that do. So a pre-approval is when everything has been verified and has been submitted through the underwriting system and given an automated approval. So as a listing agent, if you're selling a home and you have two offers, one's a pre-qualified offer and one's a pre-approved offer.
I will always go with the pre-approval.
Now, what if, let's say, the pre-approved offer is $500 less than the pre-qualified offer?
I still take the pre-approval.
Okay.
$500 is not going to make a difference.
So I know that you've been in real estate for quite some time now. So why is that? What are some of the things that has happened in your experience that's made you have that reservation about using a pre-qualification?
A pre-qualification is basically when the customer calls the loan officer and verbally tells you, I make $2,000 a month, I have maybe this credit card, this loan payment, this car loan, and you do the math based on a verbal information. That is not the same as pulling the credit and verifying everything, all the liabilities on credit, analyze the income. So the possibilities of the loan falling apart in the middle of a contract is bigger if you're going in with a pre-qualification and not with a pre-approval.
Absolutely.
Yeah.
And so some of the reasons for that, probably the biggest one that I see is a lot of times someone will tell me, hey, Jeremy, I make $45,000 a year. Well, when I get their pay stubs, I see that they make $30,000 a year, and then they've got $15,000 worth of bonuses and overtime. Well, with bonuses, with overtime, with commission, with any non-salary or non-hourly set 40-hour rate, you have to have a 2-year history. Not only is it a 2-year history, but we have to take an average of those 2 years. So yeah, you might be making 45 now, but 2 years ago, if you were still at that same job, maybe you were only making 28. So when we average that out, all of a sudden the number's completely different. Your averaged income is $38,000, and now that home that you have under contract, you can't afford. So, I mean, every month I see it in different groups that I'm on, and I also get calls from different agents, saying, Jeremy, can you please try to save this loan? They were with this credit union or this bank, and everything just fell apart. We don't know what's going on. Can you save it? And quite often when I look at it, it's a situation to where that was a pre-qualified buyer that was not pre-approved and should have never got that home under contract.
And in a market like it is right now, that is a very competitive market, that is very often you see highest and best, in which is more than one person putting an offer on the same house. When you have a pre-approval versus a pre-qualification offer, that pre-approval offer has more weight. Even if it's lesser than the other one, that listing agent will probably go for the pre-approval. So we have more chances of winning that offer.
Yep, absolutely. And I always, encourage a listing agent to reach out to that mortgage loan officer, banker, broker, with that pre-qualification or that pre-approval, and ask them questions. Make sure that that person is really a solid buyer, that they've been verified their income, their assets, their credit, and that they're truly going to be able to buy that. Taking and making that quick 5-minute phone call can save you and your seller possibly from having to be drug out for 2 months under contract and then have to put the house back on the market. So, it's sad when that happens, and we do see that, unfortunately, more than it should happen. So, I want to thank both of you for coming on today and giving out some education to the good folks at home. So, Kai, is there anything that you would like to add and just kind of talk to the people at home watching and, give them tips on how that they can prepare themselves to become a homeowner?
I would say if you're looking to become a homeowner, I would start by ordering your credit report and seeing where you stand. It's very important to know your credit score, to know what is on your credit report in order to even move forward and start building. And I always say that is the greatest place to start. And anyone who is looking to purchase a home, I actually can sit down with them, do a full credit report audit, and look at some of the qualifications that you guys look at when it's time to purchase a home, and kind of tell them where they stand and if they're ready. And I've gotten so familiar with what it takes for you to get an approval that I can pretty much look at a report and say, okay, you can call Jeremy now.
This is true. This is true.
and I've done that. I've said, oh, okay, well, you're good. Just call Jeremy. And they're like, no, you can.
Yeah.
And so I actually sit down with them and go over different things that they might need to do, or things that are included when you go through the pre-approval. But I would say to start there. Start with your credit, and then from there, go for the pre-approval. And I tell people that all the time, because no realtor really wants to touch a file that doesn't have a pre-approval.
Very true. Very true. So Daniella, would you also just mind sharing a few things that the people watching at home could kind of take from this and use to make their home buying process a success?
Well, I would encourage everybody, if you're thinking of purchasing a house, if it's something that is on your near future goal, or your lease might expire soon, give a call to your loan officer. Contact Jeremy, because if you're gonna look for a loan officer that, you know, is gonna give you options, he's gonna actually, because you're really good at that. We have been working with Jeremy for a very long time. We know Jeremy for what, 12 years? Very long
I
time.
think actually more than that. I think we're about
Yeah.
15 years now because it was 04, I believe.
Yeah.
A little bit less for me.
A little
but
bit
it's
less.
fine. It's
The
fine.
younger one.
You might have been in high school then, so.
No, but when you're thinking about going on this purchase, which is the biggest investment of your life,
Absolutely.
you want to go in and find out all the information. And sometimes you might not be able to qualify them right away, but you'll be able to give them a game plan. You can say, you know what, there's certain things we have to work on your credit. Let's call Kai. And Kai will fix your credit. And we put them on a game plan that they will actually be able to afford a house or qualify for a house in the near future. And it's not never get a no for an answer. It might be a not now, but it's going to be a yes in a few more months. So I encourage you guys to call.
And she definitely means that when it's not a no, it's just later. Because sometimes I'll tell you, Daniela, I don't know what to do with this person, and you're like, well, we're going to put a plan together so that whether it's 2 years, 3 years, however long it takes. So that's really awesome, and Daniela will stay in contact with you. So you know, both of their information is available. So you can get them there. They're going to be tagged in this as well, and the information will be below. So thank you both for your time. I appreciate y'all having y'all on today.
Thank you. Thank you.
All right, awesome. Hey, and if you're in Jacksonville, support the Jags. We've got an awesome quarterback. He's rocking the Super 70s stash. So go Gardner Minshew, and everybody have a wonderful night.
Okay.
Bye.